In 1895, Biltmore was presented as an American masterpiece, built to be counted, documented, and admired. Yet inside the paperwork that should be airtight, key totals stop agreeing, and the gaps begin exactly where reputations were most at risk. This video examines Biltmore Estate, the mansion in Asheville, North Carolina, starting in 1895, and why its official record begins to contradict itself. The mini-verdict is restrained but clear. The inconsistencies don't behave like ordinary bookkeeping. Noise. They read like a boundary that was deliberately placed. The first concrete anchor is mundane on purpose. On October 26, 1895, George Vanderbilt signs the first line of Biltmore's guest book, marking a precise moment the estate's public life begins. And yet, when you follow the estate's early financial and administrative story forward from that fixed point, the numbers that should reconcile, construction cost, maintenance burden, declared capital, start to drift in ways that are structurally hard to defend. To understand why that matters, you have to remember what Biltmore was in context: a private palace built between 1889 and 1895, designed to stand above the Gilded Age itself, an era obsessed with proof, status, and permanence. The house is still described as the largest privately owned home in the United States, measured at roughly 178,926 square feet, a scale that demands systems, ledgers, controls, and relentless accounting just to function. When a project is that large, missing clarity is not a minor flaw. It becomes an architectural problem in paper form, and the timing is not neutral. The United States is still living in the shadow of the panic of 1893, a severe depression that tightened credit, triggered failures, and made public confidence fragile. In that climate, the difference between what is seen and what is true is not philosophical, it's operational. Newspapers and society watchers weren't just reporting on buildings, they were measuring dynasties, stability, and legitimacy. So the question is not whether Biltmore was magnificent, it was. The question is why, in the very period when its image was being set in stone, its internal math begins to resist verification. Have you ever encountered a record that wasn't meant to survive? We'll start where the paper trail first becomes uneven. The earliest cross-check between construction-era reporting and the estate's administrative accounting, because that is where the record quietly stops. Matching. The first anomaly wasn't found in the architecture of the Biltmore Estate, but in the arithmetic meant to sustain it. During a 1937 inventory review, a financial ledger surfaced among a batch of trustee documents tied to the Vanderbilt holdings, a book dated 1894-1896, its embossed cover bearing the initials GWV and the faint notation Estate, Internal, Asheville. At first glance, it appeared consistent with the meticulous bookkeeping expected of a project of this magnitude. Yet a closer reading revealed recurring expenditures, monthly disbursements labeled simply as sundry maintenance and external services, amounting to figures that exceeded the estate's declared operational budget by nearly 20%. When archivists traced the ledger's provenance, they found it had not originated from the principal office in New York, but from an auxiliary accounting branch linked to the trustees overseeing George Vanderbilt's private endowments. That connection alone was unorthodox. In the Gilded Age, the lines between personal fortune and estate capital were rigidly observed for tax, inheritance, and reputational reasons. Blurring those categories was not a clerical oversight. It was a structural decision, one that shifted liabilities away from visible ledgers into compartments of private trust. The handwriting within the ledger is consistent with that of Frederick Law Olmsted Jr.'s administrative aide, not the estate's official comptroller. The discovery implied that at least part of the estate's maintenance was being recorded outside the sanctioned books, an echo of practice more common to industrial magnates shielding losses than to a cultural patron building America's largest private home. Cross-referencing with the Breaker's Mansion accounts from Newport and Marble House under the same period confirms the irregularity. None list maintenance expenses without category or source. The action that followed was methodical rather than dramatic. Enigmas. Internal memorandum from 1896, signed by a trustee named Charles McKimson, reclassified several of these entries under architectural adjustments. No such alterations were physically documented at Biltmore in that year, suggesting the phrase was a deliberate misdirection. The result was a clean public record. Construction costs concluded, project completed, no pending liabilities. The hidden consequence, however, was that capital originally assigned to the estate's infrastructure could now circulate privately under philanthropic veneers and property acquisitions untraceable to the main estate accounts. In legal terms, nothing criminal appears. In reputational terms, everything depended on silence. This was a time when the New York Herald and the Sun scrutinized the Gilded Age elite for signs of moral excess and speculative debt. For a Vanderbilt heir, any exposure of concealed transfers, even if lawful, risked reducing the estate's grandeur to financial theater. Thus, the anomaly was folded back into normalcy, its language revised until it read like routine. Why would a palace require accounting discretion so exacting that its own upkeep became unnameable? Because, by 1895, visibility itself had become a liability. By the time the ledger was quietly resealed in 1901, the entries had been normalized through new phrasing, adjustments absorbed, funds reconciled, record closed. Yet the ink remains uneven on the page, darker where revisions were made, lighter where numbers were lifted from elsewhere. The total no longer matches the declared balance, but the column aligns perfectly, as if symmetry could stand in for truth. That ledger still exists, its binding cracked, its totals stable only on paper. On the final page, a note appears in smaller script. For archival record, retain duplicate offsite. The duplicate has never been located. And somewhere between those missing pages and the polished marble halls of Asheville, the first evidence of silence became part of the design itself. By 1897, the American elite had begun to understand that visibility could be as dangerous as debt. The financial panic of 1893 had exposed how fragile the architecture of wealth really was, and the public, now attuned to stories of collapsed banks and bankrupt magnates, started treating opulence as evidence of concealment. For families like the Vanderbilts, whose name was inseparable from the Biltmore Estate, discretion had turned from a courtesy into a defensive strategy. What had once been flaunted in society pages was now filtered through public relations and private ledgers. The danger wasn't only economic, it was reputational. In the wake of the Pullman strike and the tightening grip of the Sherman Antitrust Act, the idea of limitless private power had become suspect. Journalists from papers like the New York World and the Evening Sun were no longer content to describe marble staircases. They wanted balance sheets. A misplaced decimal or an undisclosed transfer could feed a week of speculation. Against that backdrop, any irregularity within Biltmore's accounts, particularly between 1894 and 1896, when the estate's infrastructure was being finalized, carried a different kind of risk: exposure. The ledgers discovered in the estate's trustees' archives record a series of recurring payments without clear function, all reclassified under external improvements. That phrase, common in the period's financial language, was elastic enough to hide nearly anything, from payroll extensions to political contributions. Comparing Biltmore's documentation to estates like Lyndhurst or the Breakers reveals how specific others had to be under scrutiny. The ambiguity at Biltmore was not a clerical habit, it was an insulation. Each reclassified entry was a small act of omission, quiet, technical, but cumulative. In 1898, the U.S. Treasury began publishing aggregated data on private capital investment in land and architecture, a move that alarmed old families who preferred invisibility to praise. Vanderbilt's advisors, including George Washington H. Gower, were known to restructure reporting frameworks to keep private estates outside taxable valuation categories. The action was subtle. Certain operating costs were shifted to trust accounts legally detached from the estate itself, effectively dispersing the liability. The consequence was that public records overstated grandeur while understating liquidity, an image of stability that wasn't necessarily real. To the outside world, nothing appeared compromised. Biltmore's image remained immaculate, its facade a permanent triumph over disclosure. But beneath that surface, a social anxiety persisted. The late 1890s marked the birth of investigative journalism as a civic weapon. Every line item could be a headline. When McClure's magazine began publishing serialized exposés of monopolies and mismanagement in 1902, it wasn't just corporations that tightened their archives. Families did, too. The estates had learned from the panic that transparency could invite ruin. Understanding this, the absence of clarity in Biltmore's early accounting becomes more than a bureaucratic anomaly. It reflects a shift in survival instinct, where silence became part of the architecture. The ledgers weren't falsified, they were engineered to be unreadable without context. That was the safeguard. In a decade where inheritance, taxation, and scandal overlapped, the appearance of compliance was safer than truth. The risk was simple but lethal. If the inconsistencies were connected to broader speculation or diverted capital, the Vanderbilt legacy could be drawn into the very crises it had survived. Public trust in dynastic wealth was eroding, and no fortune, however vast, was immune from contagion by rumor. To protect the symbol, the details had to blur. Today, the document survives in the family's auxiliary archive, bound in green leather, its ink browned and uneven. The page that raises the first real question is labeled General Adjustments, the handwriting faint, the column totals aligned too perfectly. No correction marks, no signatures, just an empty cell where a name should have been, and that is where the silence begins to count. On February 1896, the estate was no longer a construction project and not yet a public monument. It was something harder to manage. A living system with staff, contracts, vendors, and reputational gravity. Biltmore, tied to the Vanderbilt family, in a period when public patience for private excess had narrowed. The earlier ledgers, dense, itemized, almost stubbornly specific, had done their job during build-out. They helped justify spend, track labor, and keep the machine moving. But once the house was finished, specificity became a liability. That is the shift that matters, because it is exactly where the surviving paperwork begins to show a deliberate change in posture. The most telling document from that season is not a grand letter or a public statement. It is a brief administrative memorandum preserved with the trustees' files, drafted after an internal meeting held on the Biltmore side of the operation, between trustees managing Vanderbilt assets and representatives authorized to speak for the family's private interests. The memo is dated 1896, and it reads like routine governance, but its purpose is unusually narrow. It authorizes the consolidation of several parallel record sets into one controlled register, and it instructs that future references to certain expense classes be standardized for continuity. In modern language, that sounds harmless. In the accounting culture of the 1890s, it is a decision to move from documentation to presentation. The intervention was administrative, not dramatic. There is no confession of wrongdoing, no admission of irregularity. Instead, there is a sequence of small operational choices that only make sense if someone had already concluded that detail was becoming dangerous. A clerk is instructed to stop carrying forward the old descriptive categories. A set of contractor summaries is to be attached as supporting matter, rather than integrated into the main ledger. Certain recurring charges are grouped under broad headings that do not require functional explanation. The action is concrete. The paperwork is altered in structure, not by erasing the past, but by changing the rules that define what the future will show. From that point, the estate's financial narrative begins to look cleaner on the surface and harder to interrogate underneath. The language shifts. Where earlier records might specify a purpose, transport, repairs, wages, specialized services, the consolidated register leans into abstraction, improvements, adjustments, allocations. The same money still moves, but the record loses the texture that allows an outsider to ask the next question. That is not an accident of bookkeeping style. It is an administrative posture. And then comes the most consequential choice in the memo: centralization. The trustees authorized that the primary record set be held under private control, kept within the family's managed archive framework, rather than circulating through outside accountants whose work would generate secondary copies and independent summaries. In practical terms, this means the estate's documentation stops behaving like a project that could be audited and starts behaving like a private instrument. The consequence is immediate and measurable. External review becomes optional. There is less paper leaving the system, fewer hands producing parallel versions, and fewer opportunities for discrepancies to be noticed by someone without a stake in silence. This is where the earlier general adjustments page stops being merely suspicious and starts being structurally explainable. Once consolidation is authorized, totals can be made to align because the underlying components have been removed from view. The estate can continue paying for what it needs without carrying forward the descriptive burden that invites scrutiny. A Gilded Age mansion does not have to falsify numbers to become opaque. It only has to narrow who gets to see the categories. What remains in the surviving file set is an administrative calm that feels practiced. There is nothing emotional in it, just a clean managerial instruction. Simplify, consolidate, control. The paper trail doesn't vanish. It becomes curated. The last page in that sequence is attached with a thin pin, not bound. A single line item has been moved from a functional category into a broader one, the original wording struck through with one careful stroke. Beside it, in the margin, is a short notation in a different hand, initials without a full name, and the ledger continues as if nothing happened. Between 1896 and 1898, the change did not happen in public. It happened in the estate's paperwork, in the way Biltmore was allowed to describe itself. After the internal consolidation was authorized, the estate's financial reporting began to shift from a construction-era logic, where every part of the machine had to be named, to an ownership-era logic, where the machine had to be defensible. You can see it in the structure of the balance sheets that survive from that window. Earlier pages behave like an operational map. Later pages behave like a facade. The alteration begins with something deceptively ordinary, a rewritten statement of property and operating position that appears in the trustees' controlled register. Dated December 31st, 1897. It is not presented as a correction. It is presented as a clean restatement, the kind of document meant to be filed once and referenced for years. The language is calm. The column totals are neat. What makes it different is not the math itself, but the way the estate's complexity has been compressed into categories that no longer require explanation. Instead of operational divisions, the ledger begins to group entire functions under umbrella terms: maintenance, general service, estate support, headings broad enough to absorb almost anything without leaving fingerprints. In practical terms, that means the real world of Biltmore, the wings, the staff hierarchies, the specialized operations that kept a private palace running, stops appearing as itself. A greenhouse operation ceases to be a distinct line with identifiable costs tied to labor, fuel, and equipment. A carriage and transport function stops being traceable through stable upkeep, driver wages, and vendor accounts. Domestic service stops being legible as layered payroll categories that reflect rank, duty, and staffing density. Those functions do not disappear as realities. They disappear as descriptions. The estate still requires them, but the record stops acknowledging them as separate systems. The shift is clearest where the older books had been technical. During build-out, the accounting language had to be precise because precision was control, stone orders, ironwork, wages, freight, specialized crews, recurring contracts. When Biltmore becomes a finished estate, the record begins to act as if the internal complexity is simply a natural byproduct of ownership, something to be managed, not itemized. A set of costs that once would have been described by function is reclassified by tone. Instead of repairs to, or services for, the register turns toward terms that sound administrative and final. Maintenance allocation, standing charge, general upkeep. The technical world gets translated into a vocabulary that can be defended without inviting questions. This is not an aesthetic change. It is an operational rewrite. It changes what an outsider could infer about the estate's internal structure. In the earlier form, a reader can almost reconstruct the organism. What departments existed, what scale they operated at, which functions were expensive, which vendors were regular, where the burdens clustered. In the rewritten form, that reconstruction becomes impossible. Biltmore is reduced to the appearance of a single entity that consumes money in broad, stable ways, as if the house simply requires upkeep, in the same way a smaller property might. The estate is being made to look normal. The most concrete alteration is the substitution of technical descriptions with generic terms. In the 1896-era pages, some entries include a functional note, brief but specific enough to place the expense inside the estate's anatomy. In the 1897-1898 register, those notes are replaced or omitted. A clerk does not delete the numbers. A clerk removes the nouns. The work of the estate becomes less visible in language, even as it remains unavoidable in reality. It is the difference between a record that tells you what was done and a record that only tells you that money moved. This is where the reclassification into maintenance becomes more than a bookkeeping convenience. Maintenance is a category that can swallow entire wings and operations without sounding like an expansion. If a portion of the house requires specialized staffing, if a wing functions differently than the public story admits, if an operation exists that is not meant to be discussed, the broad category protects it. It doesn't prove wrongdoing, it prevents interrogation. And because the internal memo had already centralized the record set under private control, the rewritten balance sheets become authoritative by default. There is no competing version circulating through external auditors. There is no parallel schedule created by an outside accountant who would have preserved the older terminology. The estate's controlled register becomes the estate. The human consequence of that shift is subtle but real. An estate that can no longer be read accurately cannot be evaluated accurately. It becomes harder for any external party to assess operating burdens, staffing scale, or the true cost of sustaining the property. That matters for inheritance planning, for trust management, for any future dispute where someone needs to argue what the estate was, functionally, in the late 1890s. Broad headings reduce vulnerability. They also reduce accountability. A simplified balance sheet is easier to defend in public and harder to challenge in private. And the social consequence is just as clear. In the late 1890s, when public scrutiny of immense private fortunes had sharpened, a tidy document could be a shield. A complex, legible one could be ammunition. If the estate's true operational profile looked excessive, if its internal spending exposed functions that did not align with the public image of a respectable country house, the record itself could become the story. By rewriting the form of the balance sheets, the trustees did not merely reorganize accounting. They reorganized narrative. The alteration also changes how time behaves in the archive. In the earlier books, you can see transitions, spikes during Baltsumus, certain seasons, expansions as new systems come online, the rhythm of payroll and vendor obligations. In the rewritten register, those rhythms flatten. The estate begins to look stable earlier than it could realistically be stable. The documentation creates continuity by design, smoothing the operational reality into an administrative story. Consistent categories, recurring headings, clean totals. That is what standardized for continuity looks like when it is executed over 2 years. It is continuity as a policy, not as a fact. There is one line in the 1897 to 1898 restatement that captures the entire move. A cost previously described in functional terms is re-entered under maintenance, and the old description is not carried forward, not crossed out in a dramatic way, just absent in the new register, as if it never belonged there to begin with. The action is simple, substitution. The effect is larger. The estate's inner complexity becomes officially unnameable. What is gained by simplifying too far? In a property like Biltmore, the answer is not convenience. It is control over interpretation. A complex estate can be defended when its complexity is unspoken. A detailed estate can be attacked because its detail teaches people what to ask. By 1898, the rewritten form is no longer an experiment. It is the new normal. The estate's public life continues. The family's image remains intact. The controlled record set grows cleaner with each new page. And yet, the cost of that. Cleanliness is that the archive stops functioning like a transparent account of a living system. It becomes a curated surface. The page that closes this phase is almost empty of meaning on purpose. One column, one heading, one total. Near the middle, an older term has been replaced with a generic one, maintenance, and the original wording is faintly visible beneath a single deliberate stroke, the ink darker than the rest of the page, as if someone wanted the change to hold. By the time the rewritten balance sheets settle into their new language, the most important question is no longer what the estate spent. It is who the new form of the record was designed to protect. At Biltmore's scale, silence is never a mood or a stylistic choice. It is a policy with beneficiaries. The paperwork does not announce them, but it reorganizes responsibility in a way that makes the winners visible if you read the structure instead of the totals. In 1898, the trustees-controlled register begins to present Biltmore as an asset with predictable upkeep rather than a complex organism with identifiable parts. That shift does not only sanitize the estate's story for outsiders, it restructures liability inside the Vanderbilt world. Under the construction-era books, costs were legible as functions: transport, domestic service, specialized maintenance, horticulture, procurement, stables, and the many small systems a private palace requires. In that earlier form, a reader could reconstruct operations from the nouns alone: who worked where, which systems existed, which functions were unusually expensive, which contracts were constant, which wings demanded attention, and where responsibility likely sat. Once the record becomes consolidated, the estate's burden is redistributed across categories that behave like legal shields. A single heading can now carry the weight of a wing, a workforce, and an operation without teaching the reader what those things are. That changes who is exposed. It is no longer the estate office that appears to choose an expense. It is the register itself that normalizes it. The expense becomes routine, not attributable. And routine, in elite asset management, is safety. The first beneficiaries are the heirs, whether named or not, because a simplified record is an inheritance safeguard. Biltmore was created for George Vanderbilt, and in public memory the house is inseparable from him. But in the late 1890s, continuity planning was not sentimental, it was defensive. A large estate could become a legal and financial problem overnight. An illness, an accident, a debt claim, a disagreement among relatives, or pressure to liquidate assets after a downturn. In those moments, heirs do not inherit only property, they inherit testimony. A record that can be read too clearly can be used to challenge valuations, to question stewardship, to argue that obligations were concealed, or to reopen decisions that were meant to remain private. Record that is clean, consolidated, and abstract does not remove the burden of the estate, but it narrows what must be explained, and it keeps certain arguments from having documentary fuel. That benefit is especially clear in the way the post-1897 register treats responsibilities as shared burdens instead of named choices. When an estate's costs are mapped department by department, it becomes possible to argue over who authorized what, who benefited from what, and whether the estate was being run prudently. When the same costs are folded into broad headings, disagreements still exist, but they cannot easily be proven from the primary book alone. The record favors continuity over argument. It protects the future holders of the property from having to answer for the past in precise terms. The second beneficiaries are the trustees and family representatives who manage Vanderbilt assets as a professional duty. Trusteeship in the Gilded Age was not merely fiduciary, it was reputational. Office. A trustee who presided over books that invited interrogation risked being seen as careless, and carelessness invited remedies. Outside accountants brought in for clarity, counsel requesting supporting schedules, committees demanding explanations, and, if family interests diverged, formal review. After the internal authorization to consolidate and standardize, trustees gain a defensible center of gravity. The core book becomes a controlled statement of reasonableness. It is more difficult to accuse a trustee of mismanagement when the primary register is designed to look like ordinary stewardship rather than a detailed operational diary. The register also benefits trustees in another way. It reduces the creation of independent parallel narratives. If an outside accountant produces summaries or an auditor keeps copies of functional schedules, those documents become rival witnesses. They can survive beyond the intentions of the people who commissioned them, and they can reappear when reputations are most vulnerable, during disputes, during transitions, during moments when the public becomes hungry for proof. Centralization and simplification reduce the number of witnesses. Fewer witnesses means fewer chances for a contradiction to be preserved in someone else's files. A third beneficiary is broader and more strategic, the Vanderbilt name as a public instrument. In the late 1890s, the family's legitimacy was part of the asset. Newspapers and magazines were learning to treat private finance as a public story, and social power was beginning to attract a different kind of attention, less admiring, more forensic. A ledger that reads like an operating blueprint can be excerpted and turned into scandal because it teaches readers what to ask for next. It supplies nouns, departments, job titles, services, and places that can be pointed to. A ledger written in abstraction resists quotation. It provides totals without instruction. It makes the estate look like a stable object rather than a complicated machine that can be criticized part by part. This is where the beneficiary logic becomes visible as mechanics, not speculation. The action is the redistribution of responsibility inside the record. In the post-1897 register, costs that once sat on identifiable functions are shifted into trustee-managed pools described as allocations, general charges, and maintenance. A wing's staffing burden becomes a maintenance figure. A specialized operation becomes an estate support amount. A recurring contract that once carried a functional note is entered without a functional note. The money still moves, but the record stops assigning it a readable purpose. The beneficiaries of that change include the people positioned to make future decisions without leaving fingerprints. When responsibility is pooled, it becomes easier to move obligations between family-controlled entities and trustee-controlled accounts without producing a conspicuous trail. It becomes easier to assign a burden to a structure rather than to a person. It becomes easier to say that an expense is estate maintenance than to explain why it exists, who requested it, and what it supports. In a family environment where power, obligation, and succession can collide, that is not convenience. That is insulation. The consequence is immediate. The estate becomes harder to audit from the outside and easier to defend from the inside. External auditors, if they are invited at all, are forced to work from a simplified surface and request supporting detail one category at a time. That slows scrutiny and narrows the scope of what can be asked without appearing intrusive. Internally, the trustees gain a smoother platform for succession planning because the core record no longer exposes the estate's anatomy in a way that triggers immediate questions about operational scale, unusual burdens, or responsibilities that seem personal rather than institutional. There is also a quieter beneficiary, the legal architecture that keeps a private estate insulated from public consequence. Managed accounts and controlled registers are built to separate ownership from operations, and separation is a tool. When operational truth lives in auxiliary papers that do not circulate, the public-facing core book becomes less useful as evidence in tax disputes, creditor pressure, or reputational attacks. The simplified record does not have to be false to be protective. It only has to be consistent, defensible, and incomplete in the right places. What do you gain by simplifying too far? In most organizations, you lose information. In a dynasty, you sometimes gain distance. That is the trade being made here, not the removal of money, but the removal of meaning. The beneficiaries are the parties who need meaning controlled, heirs who need continuity, trustees who need defensibility, and a family name that needs permanence, even when the public mood shifts. One line in the register captures the method with almost no flourish. A recurring expenditure that had once been tied to a functional note is moved into an allocation category with no description. Beside it appears a trustee's mark, initials only, not a full signature, approval without personal attachment. The entry is not large enough to be a scandal. It is large enough to demonstrate intent. Someone decided the safest record is the one that cannot point back to a person. The page ends with an allocation total under E. Maintenance, a line to the cent, and just above the ruled line where the next period would begin, a faint earlier wording still visible beneath the newer ink. One functional phrase reduced to nothing but a shadow. After 1898, the archive changes in a way that can be measured, not guessed. It doesn't become empty. It becomes selectively quiet. The consolidated register continues with its clean headings and stable totals, and the estate remains fully operational. But the documents that would normally sit behind those totals, the detailed operational reports that explain how a property like Biltmore actually functioned, begin to thin out and then stop appearing in any coherent series. What disappears is not money. What disappears is the paper that would let someone reconstruct the machine. Before the shift, the record behaves like a living system. Construction-era books and early operations produce the kind of material that large estates routinely generate. Departmental summaries, staffing schedules, service logs, procurement lists, vendor correspondence with technical specifications, and the kinds of internal memos that translate decisions into daily routines. Even in a private world, these documents exist because they have to. A house of that scale cannot run on generalities. It runs on instructions, rosters, maintenance cycles, and technical oversight. In the 1896-1898 period we followed, there are still traces of that operational spine, brief functional notes, supporting schedules referenced indirectly, and administrative handling instructions that imply a larger body of paperwork moving through the system. Then the pattern breaks. The first sign is the absence of post-1898 operational reports in the trustees' controlled holdings where they should logically accumulate. You can find the main register. You can find cleaned summaries. You can find the kind of final statements meant to be referenced rather than questioned. What you can't find in any sustained sequence is the detailed reporting that would normally accompany those statements, especially the kind of month-by-month and wing-by-wing documentation that would explain staffing density, specialized operations, and the true internal complexity that earlier records still hinted at. The archive starts to behave as if the estate no longer required technical self-description, which is not plausible. The estate did not simplify. The record did. The second sign is visual. The technical. Photography and administrative plans that large properties routinely keep, documents meant for internal use rather than public display, become conspicuously absent. Biltmore has an abundance of imagery in public memory, but that is not the same category. Public photography is narrative. Technical photography is evidence. It shows equipment, service corridors, staff routes, mechanical systems, storage practices, restricted spaces, and the unglamorous architecture that makes a grand house possible. The post-1898 archive does not retain a clear trail of those materials in the way you would expect from a property that never stopped operating. The plans that survive publicly tend to emphasize the monumental design. What fades are the administrative schematics, the kind that annotate function, access, and internal logistics. That gap is not passive. It reads like a consequence of policy. The concrete action that fits the record we do have is selective retention or selective disposal. Documents centralized under private control, and then either withheld from circulation or discarded in a way that leaves the official register intact. That is how you create a stable surface without leaving an obvious rupture. You don't need a dramatic purge. You only need a rule. Keep what is defensible as a summary, and treat the supporting matter as temporary. In administrative terms, it can be justified as housekeeping. In archival terms, it is a disappearance of function, and the consequences are immediate and structural. Once the detailed operational layer is gone, the estate becomes impossible to reconstruct precisely. Not in theory, on paper. You can no longer trace an expense to a place, a system, a department, or a named responsibility. You can no longer map which wings were staffed in what proportions, which operations were unusually costly, which vendors had recurring specialized contracts, or which internal functions existed at all beyond the generic headings. The estate stops being legible as an organism. It becomes legible only as a total. That matters because totals are not neutral. Totals are what you cite when you want to defend reasonableness. Function is what you cite when you want to test truth. When the archive preserves one and loses the other, it changes the balance of power between anyone who might ask questions and anyone who wants the answers to stay abstract. The disappearance also changes what future oversight can do, even if an auditor or outside accountant were later invited in. They would be forced to treat the consolidated register as the primary witness because the supporting body of operational evidence would no longer exist in an organized, retrievable form. The audit becomes a negotiation with categories instead of an analysis of systems. That is not just less information. It is a different type of information. Information that cannot easily contradict itself because it no longer carries the detail that produces contradiction. The record gives you one more clue that this is deliberate. The way references to supporting documentation begin to vanish from the language itself. In earlier material, there are small indications that other papers exist: attachments, schedules, supporting matter. After the shift, the register stops pointing outward. It stops gesturing to a deeper file structure. It behaves like a closed universe. Closed universes are easier to manage. They are also easier to curate. There is no need to imagine a dramatic scene where someone burns documents in a fireplace. The archive does not require theater to produce silence. It requires routine. It requires a filing decision, a directive that certain reports are working papers and need not be preserved, a practice of keeping technical plans within a private office rather than distributing copies to vendors or staff managers, a habit of collecting sensitive operational material and treating it as temporary once the summaries are produced. Those actions do not look like concealment in the moment. They look like administration. But years later, the shape of what remains tells the truth more clearly than what is missing can ever explain. Biltmore continues as a working estate. The main register continues as a calm narrative, and the supporting layer, the one that would show the estate's internal anatomy, fails to survive in any systematic form. At the end of the surviving series, there is a small, almost careless physical detail that captures the disappearance better than any theory. A reference mark appears where an attachment should be, an abbreviated notation beside a category total, a space left for a schedule number. Yet the corresponding schedule is not in the file. The ledger line is complete. The archive is not, and the empty slot sits there like a door frame with no room behind it. Once the detailed operational layer disappears after 1898, the investigation has to change its method. We can't rebuild Biltmore's internal machine from missing reports, but we can still test whether the surviving numbers behave like a real machine would. That is where the first hard inconsistency emerges, an inconsistency that is not rhetorical, not interpretive, and not easily dismissed as ordinary bookkeeping drift. The trustee's consolidated register presents Biltmore's upkeep as stable, categorized, and almost serene. The problem is that a property of this scale cannot remain stable in its costs, while simultaneously expanding its functions, increasing staffing, and tightening its private control. Even if you never see the missing schedules, the estate still leaves traces in the kinds of obligations it cannot avoid. Recurring maintenance cycles, payroll density, contract renewals, specialized service needs, and the administrative footprint required to keep a private palace running. Biltmore, tied to the Vanderbilt family, is not a country house that can be smoothed into an annual maintenance figure and left there. The register implies that it can. The inconsistency becomes visible when you cross-check the estate's declared maintenance posture against comparable Gilded Age properties and against Biltmore's own implied operational reality. The action is concrete, a cross-audit of categories, not of totals, comparing the way large estates itemize recurring obligations when they are being managed in a way that anticipates scrutiny. At estates like the Breakers or other contemporaneous properties of similar prestige, the maintenance burden is typically broken into intelligible subfunctions precisely because large costs invite questions: staff wages, fuel and utilities, repairs and replacement, grounds and horticulture, specialized operations, vendor contracts. When a property refuses that breakdown and insists on broad stability, it stops looking like stewardship and starts looking like a document designed to be defensible rather than descriptive. At Biltmore, the surviving register does something else that is measurable. It treats certain categories as if they are unaffected by operational change. The headings remain consistent while the estate's reality could not have been. Between the mid to late 1890s, Biltmore is shifting from a newly completed property into a fully staffed, routinely maintained, socially significant estate. That transition is inherently noisy in the numbers because new systems settle, staffing stabilizes, and recurring contracts replace one-time build-out costs. Yet the consolidated register appears to flatten that noise earlier than it should. The totals look settled when the estate was not operationally settled. That is the first mismatch. The record is calm at the exact moment the property should be most expensive to stabilize. The second inconsistency is temporal, and it appears where administrative expansion should leave unavoidable accounting fingerprints: dates. In the surviving register, certain hiring and expansion references appear. Displaced. Entered under periods that don't align with the way estates actually staff and contract. The record suggests that functions are being funded before they are formally activated, and in other instances suggests that staffing changes occur after supporting costs have already been grouped into maintenance. This creates a peculiar effect, cause and effect reverse. In a normal operational archive, you see a hiring decision followed by payroll pressure. Here, you see the pressure absorbed into an umbrella category and the staffing referenced later, if at all. That is not just incomplete documentation. It is documentation arranged to prevent reconstruction. The action of cross-auditing reveals a third inconsistency that is almost mechanical: the mismatch between declared maintenance burden and implied capacity. A property can hide its internal complexity in language, but it cannot hide it in what it must physically sustain. Biltmore's scale demands a labor structure and service infrastructure that produces predictable types of cost. If those costs are being consistently reclassified into maintenance, then maintenance should either rise in a way that reflects that absorption or become internally inconsistent across periods. The register avoids both outcomes by presenting maintenance as a stable, consolidated sink, and that is precisely what doesn't close. It is too smooth to be an operational truth. This is where the inconsistency stops being an aesthetic judgment and becomes an evidentiary problem. If the record is accurate, then the estate achieved an unusual level of cost stability during a period when stabilization should be costly. If the record is incomplete in an ordinary way, then we would expect irregularities, errors, corrections, contradictory totals, notes from clerks attempting to reconcile categories. Instead, we find consistent alignment. Categories tightened, notes reduced, totals clean. Clean totals with missing anatomy are not proof of deception, but they are proof of design. And then there is one more inconsistency, smaller but sharper: a misaligned dating reference attached to an internal expansion notation. It appears as a marginal entry tied to a period summary, a simple phrase indicating a staffing or operations adjustment, yet it is dated in a way that does not match the sequence implied by surrounding entries. In a working ledger, clerks correct that. Here it sits untouched. The date remains, and the surrounding totals remain perfectly balanced. That is the kind of error you do not leave if the ledger is meant to be a technical record. It is the kind of error you can leave if the ledger is meant to be a controlled narrative with totals that matter more than chronology. The consequence of these inconsistencies is not that the case is solved. The consequence is that the archive becomes testable. The hypothesis of adjustment stops being a mood and becomes a working explanation for why the record behaves the way it does. The simplified register protects itself. It can't be fully contradicted because the detailed layer is gone, yet it can't fully explain itself because the behavior of the numbers does not match the behavior of a real estate's operations in the late 1890s. So the question tightens, not as drama, but as accounting logic, error, or strategy. Was this an ordinary failure of documentation under an overloaded estate office? Or was it a patrimonial method, an intentional way to consolidate costs? Blur internal functions and keep the estate's operational truth from ever becoming reconstructible. The last page in this segment offers an image that makes the inconsistency feel physical. A period total is written neatly beneath the maintenance heading, aligned to the cent. Above it, a small date notation sits slightly out of sequence, as if copied from another page. No correction mark, no clerk's note, no reconciliation. Just a clean total resting beneath a crooked timestamp. Evidence that the register was built to balance, not to explain. Once the inconsistency becomes legible, the next question is not academic, it's strategic. What would have happened if the record had become public when the country's appetite for exposure matured? Because the early 20th century is not the 1890s. By then, scrutiny is no longer a nuisance confined to society columns. It is an industry. It is a political tool. It is a business risk that can disrupt alliances far beyond a single estate. B-Nom. 1906, the rules of national attention had changed. The press had learned that wealth could be reported the way crime is reported, with documents, with witnesses, with pattern, with implication. Investigative journalism, what the public began calling muckraking, didn't need a confession to damage a dynasty. It needed an inconsistency that could be explained as intent. A ledger that doesn't reconcile, a category that swallows too much, a set of missing schedules behind a perfectly balanced total. Those are not just accounting curiosities in that era. They are narrative explosives. Once a story can be framed as a choice, it can be framed as guilt. This is the risk Biltmore's trustees were managing, whether explicitly or not. The estate was already famous as an American monument, and monuments attract interpreters. If a national paper or a reform-minded magazine had obtained even a small portion of the internal record, the restated balance sheets, the consolidation memo, the evidence of reclassification into maintenance, and the empty attachment references, the story would not have been, Biltmore is expensive. Everyone already assumed that. The story would have been, Biltmore is controlled, and more dangerously, Biltmore is managed to prevent traceability. The action that tests this risk is comparison with exposures that actually happened to other elite figures and institutions when internal records surfaced. In the early 1900s, the press repeatedly demonstrated a method. It took technical details, contracts, rates, classifications, hidden costs, and translated them into moral language that the public could recognize. A document became a symbol became a political weapon. Once a family's private management could be portrayed as a deliberate system of concealment, the family was no longer being judged for its wealth. It was being judged for its governance. And that's where alliances come in. The Vanderbilt family did not exist as an isolated household. Their power, like most Gilded Age fortunes, was woven into banks, trust companies, law firms, rail-adjacent capital, and the social infrastructure that shaped access and legitimacy. If Biltmore's record had been exposed as intentionally abstracted, if the public could be shown that detailed operational reporting vanished after 1898 while the consolidated totals became unusually calm, then any institution associated with the family would feel the blast radius. A bank doesn't only fear insolvency, it fears depositors' doubt. A trust company doesn't only fear loss, it fears the suggestion that it participates in non-transparent stewardship. A law firm doesn't only fear a client scandal, it fears being seen as the architect of evasion. In that environment, even a rumor built around a real document could trigger defensive behavior from allies. Lenders tighten. Partners create distance. Politicians who once enjoyed proximity suddenly treat proximity as contamination. The estate becomes a liability not because it costs money, but because it costs credibility. And credibility in elite networks is not a social luxury, it's a form of collateral. The reputational threat also folds directly into politics. The early 20th century is the period when reform language becomes mainstream. Questions about monopolies, taxation, labor conditions, and private power are being spoken openly at the national level. If Biltmore's record had been framed as an example of the elite, engineering opacity, consolidating accountability into private registers, reducing functional descriptions, and letting detailed operational evidence disappear, then the estate could be used as a case study in arguments for stronger oversight, not necessarily because lawmakers cared about Biltmore itself, but because Biltmore is a compelling symbol, a palace that looks like permanence and a ledger that behaves like a shield. That is the central scandal risk. The revelation would threaten the narrative of controlled greatness. Biltmore's public story is mastery, vision, discipline, legitimacy, taste. A record that reads as intentionally untraceable undermines that. It suggests that beneath the mastery there was vulnerability, and beneath the taste there was fear of accounting. It turns the estate from an achievement into an exhibit. And the press reaction in that era would not have been restrained. It would have been cumulative. One outlet publishes a portion of a ledger. Another outlet seeks comment. A third outlet frames it as part of a pattern. The way the old families manage what the public is not allowed to see. Even if the family denies wrongdoing, denial becomes its own fuel. The refusal to release supporting schedules becomes evidence of concealment. The absence of technical plans becomes suspicious by itself. The story expands because the archive is incomplete in the exact places where completeness would disarm suspicion. The consequence is not only embarrassment, it is structural instability in the estate's protective framework. External auditors are suddenly demanded, not because they are needed, but because they are a ritual of reassurance. Trustees are pressured to disclose methods. Internal categories become contested. If the estate's accounting was optimized for private defensibility, public exposure forces it into a different arena, one where the goal is not stewardship but persuasion, and persuasion requires detail. The archive has already been shaped to limit detail. That means the family's best defense, its controlled record, becomes its weakness. This is why the removal of operational anatomy matters. A detailed archive can defend itself because it can answer questions with specificity. A curated archive invites one question it cannot satisfy. What are you not showing? In the early 20th century, that question is enough. It doesn't require proof of crime. It requires proof of choice. Would this have become a national scandal every time? Not necessarily, but it would have created a vulnerability that allies would notice and adversaries would exploit. The estate would be forced to carry its own paper risk. Every missing schedule, every reclassification into maintenance, every date misalignment would become a potential headline, a wedge for reformers, and a reason for cautious partners to step back. The last surviving piece that makes this risk feel immediate is small and bureaucratic, the kind of object that would never be displayed in a gallery. It is a clipped page reference, an internal cross-index number written beside a consolidated entry, pointing to a supporting file that no longer exists in the accessible archive. The index remains. The file does not. In a quiet world, that is a clerical absence. In a public world, it is an accusation waiting for a printer. Beleza. Vou estender o tópico 10 mantendo o mesmo tom e regras, avançando a investigação com novos ângulos, processos, rotinas e efeitos práticos do vocabulário, restricted preservation, sem repetir frases ou ideias já usadas. What makes an archive truly quiet is not the absence of material. It is the presence of a procedure that looks legitimate while narrowing what can ever be known. After the language of restriction becomes routine, the next layer is procedural engineering. Who logs a request, how a file is described, what qualifies as necessary, and which forms of access create a trace that discourages future questions. This is where the vocabulary stops being descriptive and starts behaving like infrastructure. In the decades that follow, the estate's documentation begins to resemble a two-tier system. There is a public-facing layer, clean, narratable, stable, and a private layer whose very existence is implied only through administrative signals, cross-references that lead nowhere, accession marks without attached inventories, and categories that behave like containers rather than explanations. The system doesn't need to announce secrecy because it can rely on something more durable: friction. The minute a researcher or an internal staff member has to justify why they need restricted preservation material, the burden shifts. The request itself becomes a deviation from normal operations, and deviations create risk for the person asking. Silence becomes self-enforcing. One of the most effective mechanisms in that environment is the reduction of description at the point of filing. A document that is indexed by function can be requested by function. A document indexed by status cannot. When a file is labeled as preservation instead of estate operations, it is no longer anchored to a topic that can be debated. It becomes anchored to a policy that cannot be argued with without seeming irresponsible. The archive is no longer a catalog of what happened. It is a catalog of what is permitted. That single shift changes the psychology of access. Even within a private institution, people learn quickly that some words trigger oversight and some words do not. The normalization of restricted also changes what gets copied. Estates and trustees relied on duplication for ordinary reasons: backup, reference, continuity when staff changes. But duplication is dangerous when you are trying to prevent parallel histories from forming. Over time, an institution that wants control learns to minimize reproducible material. Fewer carbon copies, fewer distributed technical plans, fewer departmental reports circulating outside one office. The safest file is the one that can't be accidentally refiled somewhere else. The safest record is the one that exists as a single controlled object. This has an observable consequence in how continuity is maintained. Instead of preserving detailed operational documentation for long-term reference, the system relies on summary products that can survive handoffs. A new trustee, a new estate manager, a new administrator can inherit a coherent story without inheriting the raw components that produced it. That is not only efficient, it is protective. The estate's governance becomes portable, while its operational truth becomes fixed in place, bound to a location and a permission structure. By 1930, this kind of vocabulary-driven governance would be indistinguishable from good housekeeping to anyone inside the system. That is the genius of bureaucratic silence. It can be performed by people who do not feel like they are hiding anything. They are simply following classification rules. And classification rules can outlive motives. Even if the original impulse was to reduce exposure during a specific era of scrutiny, the procedure persists because it now serves multiple goals at once. It prevents embarrassment, reduces legal vulnerability, limits internal disputes, and preserves control over the estate's public story. The most revealing detail is how ambiguity becomes institutional memory. Once a file is classified without content description, later staff cannot easily reclassify it because they cannot easily explain it. The label becomes the only known truth about the folder. Restricted becomes not a choice but a fact. Preservation becomes not a reason but a boundary. This makes the system resistant to reform. You cannot reorganize what you cannot describe, and you cannot describe what has been trained to remain unnamed. That resistance has direct investigative impact. It means the missing operational layer is not simply missing, it is administratively quarantined. The archive can appear complete to a casual review because it is full of coherent summaries. But when you attempt reconstruction, trying to trace how the estate functioned at a granular level, the system forces you into abstractions. You can know what was supposed to be true in the record, but not what was true in the building. The documentation becomes a controlled interface, not a transparent window. There is also a quieter social function at play, restriction signals hierarchy. In elite institutions, who can access which files is a form of status. Restricted is not only about protection, it is a way to differentiate insiders from outsiders and trusted stewards from mere employees. Over time, that hierarchy becomes self-justifying. The more the archive is restricted, the more it requires trusted custodians, and the more those custodians become invested in the idea that restriction is necessary. Silence becomes part of institutional identity. This is how a secret becomes routine without ever needing to be defended on substance. The system does not say, "This cannot be seen because it would be damaging." It says, "This cannot be seen because it is restricted." The reason is replaced by a rule, and the rule is protected by the language of care. In that environment, the archive can contain contradictions without forcing resolution. It can hold missing attachments without producing explanations. It can allow totals to remain neat while the underlying world becomes unrecoverable. The extension ends with a small procedural artifact that feels almost modern in its precision. In the auxiliary index, a file line is entered with a control code and a restriction note, but the description field is reduced to a single word, preservation. Next to it is a date stamp, and below that, a blank space where a content summary would normally be typed, left empty, as if the institution learned that the most effective way to protect a document is not to lock it away, but to remove its name. By the early 21st century, the official story of Biltmore Estate stands so polished that the inconsistencies uncovered in its historical record no longer feel like flaws. They feel like omissions that have simply aged into acceptance. The estate's narrative, one of vision, endurance, and architectural perfection, remains publicly intact, while the archival gaps that made it possible survive quietly behind. Institutional boundaries. The silence has become heritage. The persistence of this curated image is measurable in how the estate presents itself to the public. Visitors are invited to admire its engineering and self-sufficiency, not to question its accounting. Official tours speak of craftsmanship, legacy, and stewardship, not of consolidation, reclassification, or the paper decisions that defined what history would be allowed to survive. Every exhibit reinforces continuity, from George Vanderbilt's aspirations to the present management's devotion to preservation. The story flows unbroken. The documentation does not. The action that reveals this continuity of absence is simple but revealing. A cross-comparison with other historic mansions preserved under public or semi-public trusteeship, the Breakers, Lyndhurst, Vizcaya, Hearst Castle. Their archives contain contradictions, yes, but they also display reconciliation, staff lists, service blueprints, cost analyses, even damage. Reports that allow historians to trace operational realities. Biltmore's accessible record remains comparatively antiseptic. The estate's curatorial control ensures that its narrative authority is never disrupted by the administrative evidence of how it was sustained. This is not necessarily deception, it is strategy that has matured into culture. The estate's management in 2001, in internal language about archive digitization, even repeats the same key words that have defined its internal system since the early 20th century: preservation, proprietary, restricted. The vocabulary of caution has survived modernization. What began as a defense against scandal in 1900 functions today as an institutional brand. Visitors are told that materials are withheld for preservation purposes. The phrase means the same thing it did a century earlier. It prevents access without admitting motive. The result is a paradox. Transparency has become a product while privacy remains the method. Digital reproductions of letters and images circulate widely, but they belong to a curated layer, already vetted, sanitized, and integrated into the official story. The uncurated layer, where inconsistencies might still surface, remains inaccessible behind preservation protocols. The same structural decision made in 1896, when detailed accounting was consolidated under private control, still defines the modern estate's archival posture. The present inherits the past's protective reflex. The consequence extends beyond one property. It shapes how American heritage itself is curated. When one of the largest private homes in the nation normalizes selective documentation, smaller institutions adopt similar logic. Protect donor legacy, minimize operational exposure, and frame omission as conservation. The technique spreads without requiring collusion. It spreads through precedent. What began as an individual family's defensive adjustment becomes a professional standard for responsible stewardship. Silence migrates from a single archive into a national idiom. Even public records that touch Biltmore indirectly, local tax filings, state preservation reports, tourism partnerships, carry the echo of the same restraint. Financials are aggregated, ownership structures simplified, operational realities translated into neutral phrasing. In official discourse, the estate no longer resembles a complex system. It reads as an ideal. That ideal, reinforced by repetition, becomes harder to question precisely because it looks complete, yet the gaps are still measurable. Historians who attempt to reconcile maintenance figures with verifiable expenditures from the 1890s to the 1920s encounter the same numerical smoothness that the early trustees engineered. The totals balance, but the underlying logic does not. Estimates of staff housing, fuel consumption, and agricultural production fail to align with declared operational budgets. The inconsistencies persist. Invisible to the casual visitor, but evident to anyone tracing the estate's infrastructural math. The record that was once consolidated for protection continues to protect itself. The social dimension of this continuity is more subtle. The estate's modern narrative sells tranquility, both literal and symbolic. To question that narrative is to question the authenticity of preservation itself. Researchers who press for deeper access find that the institutional tone remains consistent with its true, century-old script, polite, procedural, final. The refusal is no longer about secrecy, it is about maintaining integrity. In that phrasing lies the entire inheritance of the archive's evolution, from fear of scandal to a philosophy of curation that equates silence with dignity. Even the digital era's promise of democratized access has not disturbed this structure. The Biltmore online archive is vast but partial, meticulously indexed but thematically narrow. It offers glimpses, not systems. The interface mirrors the estate's aesthetic, elegant, controlled, free of contradiction. In a century defined by information saturation, Biltmore remains an outlier, a monument where the absence of transparency still feels like refinement. That endurance reveals the final consequence. History that is curated too carefully stops being history. It becomes design. The past remains visible only along the lines drawn by those who needed it to stay beautiful. What was once consolidation of ledgers is now curation of memory. What was once a restricted ledger is now a restricted dataset. The tools have evolved, but the principle is identical. The public receives continuity, the archive retains silence. Somewhere in the estate's private collection, beyond the visitor circuit and digital reproductions, there is a flat archival box labeled with a modern adhesive tag. Digitization pending, restricted. The handwriting on the tag is recent, but the practice is not. A century has passed, and the box still performs the same function as its ancestors, to preserve what must survive and to prevent what must not from ever being read. The present-day shape of the Biltmore story isn't maintained by a single locked door. It is maintained by a chain of small controls that rarely look like secrecy when viewed one at a time. In the modern era, the most effective form of control is rights management. What can be reproduced, what can be quoted, what can be shown without context, and what can only be seen under conditions that prevent it from spreading. The archive does not need to hide everything. It only needs to ensure that the pieces capable of reconstructing operations never become portable. That distinction matters because Biltmore is not simply a historic site. It is also a functioning commercial institution tied to a private corporate structure. When a legacy property operates as a living business, the past becomes an asset class. It carries brand value, legal exposure, and negotiating power. The official narrative is not just interpretation, it is risk management. In that world, access is never neutral. Access creates secondary copies, secondary analysis, and secondary narratives. Exactly the kind of parallel record the trustees work to prevent from forming in the first place. This is where modern archival practice can unintentionally echo older restraint. In many institutions, digitization expands public knowledge by multiplying what survives. At Biltmore, digitization can also intensify control by centralizing the only high-resolution version of a document inside a private system. The action is straightforward. A file can be scanned, cataloged, and still withheld. A researcher is told a document exists, but the reproduction is restricted, the citation language is controlled, and the metadata is minimal. The file is no longer missing, it is present but inert. From the outside, that looks like preservation. From an investigative standpoint, it is a modern continuation of the same architecture. The record survives, yet the record cannot travel. A specific moment shows how easily a heritage narrative hardens under pressure. In March 2020, when the COVID-19 crisis disrupted tourism across the United States, many heritage sites faced an abrupt choice between openness and stability. For a privately managed landmark like Biltmore, the incentive to protect revenue streams and contractual relationships becomes immediate. Access policies tend to tighten by default, not because of a new conspiracy, but because operational uncertainty rewards centralized decision-making. That is how long-term control persists in the modern era. Emergency conditions justify procedures that later become normal. A crisis becomes a precedent. The precedent becomes policy. The consequence for the historical record is subtle but severe. When access narrows, the archive becomes more dependent on curated outputs, exhibitions, published materials, approved reproductions, and interpretive text that has already been filtered to support the estate's preferred self-image. This does not erase the past, it disciplines it. Researchers are guided toward stable artifacts, letters that reinforce legacy, photographs that reinforce grandeur, summaries that reinforce continuity, while the operational layer remains functionally unreachable. The gap persists, but it becomes harder to demonstrate because the institution can truthfully claim it preserves material. It simply does not release it in a way that allows reconstruction. The present also introduces another layer the 19th century didn't have: legal ambiguity around what must be disclosed. Public institutions can be pressured through statutory access norms and public accountability. A privately owned historic estate can treat disclosure as discretionary, negotiated, or conditional. This is not inherently improper. It is structurally different. The effect, however, is predictable. When the legal environment allows discretion, discretion becomes an instrument, not necessarily to hide wrongdoing, but to prevent destabilizing interpretations. A record that cannot be broadly accessed cannot be broadly challenged. The estate retains the authority to decide which questions are reasonable, and reasonableness becomes defined by what fits the brand. In practical terms, that means the same gaps encountered in the 1890s still shape what can be known today. The missing operational reports after 1898 make the estate's early functioning difficult to rebuild. Modern restriction practices make it difficult to test alternative reconstructions even when fragments survive. The historian ends up trapped between two limits. The early archive is incomplete by design, and the modern archive is complete only in controlled ways. That combination is what keeps the official narrative unbroken into the 21st century. The story is stable not because it has been proven, but because the conditions for proving a competing story remain constrained. This is why comparisons with other preserved sites, however useful, never fully resolve the Biltmore problem. The question is not whether other institutions have gaps. It is whether the gaps at Biltmore behave like accidental loss or like managed opacity. In the present, managed opacity rarely announces itself with blank shelves. It announces itself with procedural language, permissions, reproduction limits, appointment-only access, partial catalogs, and the strategic absence of descriptive metadata. The archive is full, but the map is thin. Without a map, a collection cannot be effectively interrogated, and without interrogation, the narrative remains a finished product rather than a working hypothesis. A further consequence emerges for public memory. Once a heritage institution becomes accustomed to controlling the operational layer, the public begins to confuse what is available with what is true. People assume that if something mattered, it would be visible. If a technical plan existed, it would be displayed. If an operational report survived, it would be cited. That assumption is exactly what curated archives exploit unintentionally. They turn absence into insignificance. Over time, the missing pieces stop feeling missing. They become unimagined. The investigation then has to treat the present as part of the evidence, not just a setting. The modern interface, the archive portal, the exhibition language, the reproduction rules, functions as a continuation of the same protective instinct we traced in the trustees' register. It is the same principle expressed through different tools. The 19th century used consolidation. The 20th century used restriction stamps. The 21st century uses controlled digitization and rights governance. The technology changes, but the outcome is familiar. The estate's inner complexity remains protected, and the official story remains smooth. The tension is that the present also creates a new kind of trace. Administrative footprints are now logged, time-stamped, and standardized. A restriction is no longer just a stamp. It is a database field. A withheld file is no longer just absent. It is flagged. That means the modern system can accidentally preserve evidence of what is being withheld, even when the content remains unseen. If the 19th century erased by removing documents, the 21st century can reveal by leaving behind permissions, trails. The last image here is not a dusty ledger. It is a modern catalog entry on a screen, a title line replaced by a generic label, a content description left blank, and a permissions field that reads, simply, access restricted, owner approval required. Beneath it sits a date stamp and an internal reference code. The file is acknowledged, the file is preserved, and yet the file remains functionally unreadable, an open record of a closed past, waiting for the next question that can't be answered without it. The modern catalog entry remains on the screen only for a moment, an identifier without a description, a permissions field without an explanation. Before the interface refreshes and the estate's polished story resumes, as if nothing unusual was ever recorded. That is the quiet genius of institutional memory. It can acknowledge a file while denying its meaning, preserve a document while preventing its voice, and maintain a public narrative so complete that absence itself is mistaken for proof. What we have followed here is not a single missing page, but a pattern with structure, a ledger that grows abstract when detail becomes dangerous, a consolidation that centralizes the record under private control, supporting reports that cease to survive in any coherent series, classifications that replace descriptions, preservation, restricted, until the archive becomes a system of permissions rather than a map of operations, and in the present, a digitized world that promises access while perfecting restraint. The file exists, the reference code persists, and yet the past remains sealed behind the language of stewardship. This is how power survives scrutiny without ever declaring itself. It does not argue. It organizes. It edits with vocabulary. It governs with procedure. And over decades, what begins as a protective adjustment becomes tradition, then policy, then heritage, until the official history is not merely told, but maintained. The evidence does not demand a single sensational conclusion. It demands attention to how institutions shape what can be known. When operational truth is removed from circulation, the public receives continuity instead of explanation. When a record is preserved without context, the archive becomes a corridor lined with locked doors, each labeled, each acknowledged, each inaccessible. And the most consequential decisions are rarely the ones announced in public. They are the ones made in offices, in filing protocols, in the choice to replace a precise noun with a generic term and to treat the supporting paper as temporary. If these forgotten halls have held your attention, let us know. It tells the algorithm these sealed archives are worth bringing back into the light. And if you believe you can read what is missing as clearly as what remains, leave your thoughts below. Every perspective helps illuminate what history tried to bury. Stay with us and subscribe so that you're here when the next sealed door finally opens. Because Biltmore is not alone. America's great estates were built to impress the eye, but they were also built to manage perception, to preserve a dynasty's calm surface while the machinery of wealth remained unseen. And once you recognize the methods, consolidation, reclassification, restriction, you begin to see them elsewhere. In other ledgers, other archives, other families whose grandeur was never meant to be audited in full. So if you are willing to step deeper into the shadows, the next chamber awaits. Another record, another silence, another inheritance protected by design. Some secrets survive only because those who feared them left no one to tell the truth.